The market for BigBear.AI Holdings Inc. is currently closed, with the last reported closing price on Monday, November 17, 2025, being $5.57 per share. That figure represented a significant drop of 8.4% from the prior close, a movement that immediately tells us the market's initial euphoria following the recent earnings announcement has evaporated, forcing investors to grapple with a colder, harder reality. The expectation, fueled by a headline-grabbing earnings beat and the strategic acquisition of Ask Sage, was that this stock would continue its momentum upwards, yet the reality of Monday's trading volume, which, while high at 84.4 million shares, was actually 11% lower than its daily average, suggests a substantial portion of the post-earnings enthusiasm has been converted into profit-taking and distribution. This sharp retracement is the first, crucial point to understand. The narrative surrounding BigBear.AI as a clear-cut winner in the government-focused AI space is facing a stiff technical headwind, likely driven by skepticism over the long-term execution of its growth strategy and the mechanics of the Ask Sage deal itself. The common market belief about BigBear.AI is straightforward. It is a high-growth AI firm deeply embedded in the lucrative and relatively insulated world of U.S. national security and defense, with a significant amount of cash on its balance sheet following its previous SPAC transaction. This narrative was strongly reinforced by the Q3 2025 earnings report, which saw the company beat analyst expectations on its per-share loss, posting a negative $0.07 against an expected negative $0.06, and exceeding revenue estimates slightly at $33.14 million. Critically, the news of the Ask Sage acquisition for $250 million, a generative AI platform serving defense clients and projected to bring in approximately $25 million in annual recurring revenue for 2025, was initially cheered as a massive leap forward. However, the subsequent price action suggests a deeper, more contrarian take. The market is starting to price in the dilution and integration risk associated with that acquisition, especially given the hefty price tag and the fact that a decent portion of the purchase price for a company of BigBear.AI's size and current valuation is significant. The revenue for Q3 actually fell 20.1% year-over-year, which, despite the beat against depressed expectations, still points to a shrinking core business that relies heavily on a handful of large, lumpy government contracts. The expectation of a clean break into profitability is being challenged by the reality of a core business that remains unpredictable in its contract delivery. Zooming into the recent stock movement, the decline on Monday was particularly noteworthy because it sliced right through several minor support levels established after the earnings spike. This is a highly volatile stock, evidenced by its beta of 3.42, meaning it moves over 3 times as much as the overall market. Its 50-day simple moving average is currently around $6.68, and the stock is trading substantially below that key metric, which typically signals a lack of short-term buying momentum. The 200-day simple moving average, around $5.80, a long-term indicator, was also broken during Monday's heavy selling, which is a significant technical breakdown. Trading below the 200-day average often convinces trend-following institutional investors to cut their positions, which could explain the high volume of distribution. For retail investors, this price action is a warning sign that the excitement from early November has cooled, and a period of consolidation, or further decline, may be setting in as the larger institutional players settle their positions. On the institutional side, the latest 13F filings from the end of the last quarter show that major institutions like Vanguard Group and BlackRock Inc. have increased their positions significantly, adding millions of shares and signaling a fundamental belief in the long-term AI narrative, or perhaps simply tracking the index changes. Conversely, firms like Citadel Advisors reduced their holdings, which shows a split opinion among the sophisticated money managers. The recent buying activity from smaller institutional players like CWM LLC and Hazlitt Bird and Watson Inc., who dramatically increased their small holdings in the third quarter, may reflect the broader retail sentiment that the stock was deeply undervalued at the time. The contrast here is crucial. You have large passive managers accumulating, while more active funds are either decreasing or holding steady, indicating that BigBear.AI is still very much a consensus bet on the broader AI space rather than a conviction bet on its specific operational efficiency. The core business of BigBear.AI involves providing AI-powered decision intelligence solutions, largely to the U.S. defense, intelligence, and civilian government sectors. Their technology is designed to process massive amounts of data, geospatial, sensor, and open-source intelligence, to provide predictive insights for complex operational and logistical challenges. Essentially, they sell foresight. This is a high-margin service, but it is entirely dependent on securing and executing large, often multi-year government contracts. The legacy business has struggled with revenue consistency, which is why the market is so sensitive to any indication of future contract weakness, such as the reported reduction in U.S. Army project activity cited in the recent earnings. The Ask Sage acquisition attempts to transition the business towards a more predictable software-as-a-service model with its generative AI platform, which targets secure, controlled environments. This is a smart strategic move because it addresses the recurring revenue problem that plagues government contractors. However, it also introduces integration risk and the need to prove that Ask Sage's technology can successfully scale within BigBear.AI's existing client base. Past performance has been mixed. The company has been consistently reporting negative net income, with a net loss of $70 million in 2023 and an even larger projected loss for the current year, underscoring that the road to profitability remains long and heavily dependent on winning new significant contracts, especially in the civil sector, which they are attempting to expand into, like the recent work with airport biometric systems. Now, let's address the short-selling awareness and actionable insights, which are critically important for a stock with this profile. BigBear.AI is currently under substantial short-seller pressure. The latest data indicates a short interest of approximately 79.4 million shares, which translates to a high short interest percentage of the free float at around 18.32%. This is a significant figure, far above the average for its peer group, and signals that a large number of sophisticated participants are betting against the stock's future performance. Short sellers are generally operating under the thesis that BigBear.AI's valuation is inflated given its inconsistent revenue, lack of profitability, and the long-term uncertainties of government contracting. Firms engaging in this kind of short activity often publish reports, though none were prominently featured recently, that highlight the dilution potential from past capital raises, the dependence on a few key government agencies, and the challenge of justifying a multi-billion-dollar valuation for a company with its current financials. This short thesis is the direct counterpoint to the retail expectation of an AI-fueled growth story. The days-to-cover ratio, a metric that estimates how long it would take for all short sellers to cover their positions based on average trading volume, stands at a very low 0.71 days. This low figure is critical for retail investors to understand. It means there is minimal potential for a rapid, painful short squeeze. Even with a high percentage of the float short, the massive daily trading volume ensures that short sellers can easily exit their positions without panic buying, which defangs the short squeeze potential that retail communities on platforms like Reddit or X might be hoping for. Investors need to monitor the short borrow fee rate, which currently sits at a relatively low 0.55%. further indicating that it is cheap and easy for institutions to continue shorting the stock. A spike in this fee would be the first real signal of tightening supply. Actionable insight here is to always check both the percentage of float short and the days to cover ratio. The high short interest might feel like a buy signal, but the low days to cover ratio makes chasing a squeeze a high-risk, low-probability proposition. What's your take on the rising short interest? Smart money or manipulation? Comment below on where you stand.
Looking ahead, the future outlook for BigBear.AI is a classic high-risk, high-reward scenario, heavily dependent on a few specific catalysts. The major opportunity is the successful integration of Ask Sage, which could significantly de-risk the company by providing a stable, recurring revenue stream and proving that BigBear.AI can effectively transition into a commercially viable software company beyond lumpy government contracts. Furthermore, the company reported a record cash balance of $456 million after the quarter, which provides a substantial buffer for acquisitions and operational losses. On the risk side, the primary threat remains revenue predictability. The long sales cycle and dependence on federal funding, which can be interrupted by political delays or government shutdowns, create inherent volatility. The stock's high beta suggests it will amplify any market movement, making it a very bumpy ride. Another key catalyst to watch is the company's planned special meeting of stockholders on December 1, 2025, which will likely address aspects of the recent